Hello, everyone. This is Gonzalo and Mark from Maple Capital Partners. And today we are here to talk to you about loan products that are available to you as multifamily investors.
Absolutely. So we're going to delve into a group of different financing options that you can use on your multifamily deals. Why this is important to you as an investor is that every deal isn't created equally. That is to say that different deals are going to have different financing options that are going to be tailored towards those type deals. So you're not going to use the same type of financing strategy on a unstabilized, distressed asset as you would on a stabilized Class A asset. So we're going to go into first agency debt. By agency debt, we mean Fannie Mae and Freddie Mac, which are two GSEs. They're basically government-sponsored enterprises. That is, they're in the business of lending to provide more affordable housing to Americans nationwide. Now, they have a little bit higher of stringent requirements for lending than a local bank or a bridge lender might, which we'll delve into later. For example, they require, as part of their underwriting, that any deal that they loan on has to be 90% occupied for the last 90 days. In other words, it has to be a stabilized deal. So if you have a deal that's very distressed and only 80% occupied or 70% occupied, it's not going to work. It's not going to be approved for agency debt. Now, in addition to that, there are certain requirements on you as a sponsor. For example, the sponsorship group, if it's multiple people, has to have a net worth at least equal to the loan amount. So if you're having a problem with that, you may have to bring on a key partner or a signer on the loan with a larger net worth. In addition, you'll be required to have some liquidity. Now that may vary depending on the particular product. It may be a certain percentage of the loan amount. It may be a certain number of months of the debt service, but just know that you need to have some liquidity on the side in order to be underwritten for agency debt. Besides that, agencies require that you have experience. So if you're approaching Fannie or Freddie for a loan on a multifamily property, they're going to look at your track record. And if you don't have any experience with agency debt, it's going to be very difficult to get financing. Not saying it can't happen, but it's very rare that they would approve you for agency debt. So in that case, you're going to want to bring on a partner who has that, which is kind of what we did on our first multifamily deal as well. So the big takeaway here is agency debt is, while harder to get, it offers a ton of features that maybe a typical local lender or bridge debt product doesn't have. So for example, they're going to offer extremely competitive rates. They're going to offer some IO period, depending on the business plan. They're going to offer a 30-year amortization, which is going to lower your mortgage payment. And they may offer some extensions. So for example, if you have a 5-year term on the debt, they may offer 2-year extensions, one year sequentially for the next 2 years after those initial 5 years for you to extend the debt. So those are all really attractive features. But again, you have to clear the first hurdle of the property as well as you as a sponsor. With that, Gonzalo is now going to talk about bridge lenders.
Thanks, Mark. The next loan product I'm going to talk about is bridge loans. This product is typically used for projects that are unstabilized, meaning they have a high vacancy and they require some heavy lift up front in the form of renovations and repairs in order for the property to come up to code and have it be rentable. Typically, we've seen 75 LTC, which is loan to cost. Essentially, loan to cost is the purchase price of the property plus the cost of renovations, and the bank will loan you 75% of that total amount. What this means is that you can get a higher leverage with bridge loan. Generally, this is an IO product, meaning it's interest only, so you're paying interest on the balance of the loan and not paying down any of the principal. Interest rates and terms may vary and are typically higher than agency debt in order for the bank to compensate for the higher risk that they're taking on due to this project. There may be some extensions available to you if you cannot meet your business plan before the term ends. And generally, bridge loans have a prepayment penalty if you pay off the loan before its term. And Mark is going to talk about some local lenders and bank products that are available to you.
Yeah, so local lenders, just like bridge debt lenders, are going to vary from place to place and deal to deal. Depending on your particular locality where you're looking at deals, there may be any number of different products available to you. So that's why it's really important to either form those relationships early yourself or get a really qualified mortgage broker with tons of relationships locally, so that they can provide you with the best product to meet your needs. As far as local lenders, I would say generally a lot of banks and credit unions are a little bit more conservative than bridge debt lenders as well as agency debt. So some of the features that you're going to get and some of the terms that you're going to get are a little bit less attractive, generally speaking, than what you would get on the agency or bridge side. That said, they will make some exceptions in terms of their lending criteria based on prior relationships that they have with you. So there's an added flexibility factor there that you may not get from the bridge debt or agency lenders. Generally speaking, they're in the 70 to 80% LTV camp. So, pretty comparable to what you can get on the agency side. Now, some of them offer IO, meaning interest only. So those can vary, really 6 to 12 months is the most common that we've seen, but it really depends on your business plan and the as-is completed value. So that's where you're going to really want to tell your story to the local lender and have them understand what your business plan is. Now, on the term side, typically their debt is 5 years. We've really seen, most of them tend to gravitate towards 5 or 7 years. So meaning in 5 or 7 years, you'll either have to refi out that loan into a new product, or you'll have to sell the property. Now, in the agency space, generally you can get a little bit longer of a term, and in bridge debt, it's usually a little bit shorter. So local lenders come in somewhere in the middle there. On the amortization side, meaning how many years they amortize that loan over, it's usually shorter than both agency and bridge lenders. It's usually somewhere in the 20 to 25 year amortization space, meaning you're going to be paying off more, you're going to be paying it off in a shorter time period. So 20 to 25 years versus 30 years on the other products. Also, as with agency debt, the local lenders are debt service coverage constrained. So meaning that they're not going to look at a deal if it's not able to cover its debt service, usually 1.2 to 1.25 times. So meaning they're going to be looking at a deal to make sure that it's less risky. Typically, local lenders are going to be debt coverage ratio constrained, meaning that they're going to want to know that they're going to be paid, essentially is what that metric tells them. So they're going to want to look at a deal that offers 1.2 to 1.25 times the debt service coverage ratio. And for investors out there that don't understand what that means, a simple Google will tell you exactly what the debt service coverage ratio is. Now, on the guarantee side, the most important distinction between local lenders and agency debt lenders is that they're going to require, in most cases, a guarantee from the signers, from the sponsors. So it's going to be recourse, meaning that the debt, if for whatever reason, the sky falls and you're not able to make your debt payment, they can come after you personally and your personal assets. Whereas in the agency side, it's more non-recourse, meaning that you're only subject to your liability that you have in the deal. So if you put in $50,000 in the deal, that's the most that they can come after you for, generally speaking. Again, we're not lawyers, but that's in plain speak what recourse versus non-recourse debt is. Typically, local lenders are a little bit more skeptical of syndications. They vary in sophistication depending on how large the bank is and how many other syndications they've seen. So if you are planning on doing a syndication, we would say to have that conversation earlier with your bank of your choice, so that they can get familiar with the business model and who's going to be making the decisions. We've had experiences in the past where that has been an obstacle for us, and we had to bring on our attorney to explain the syndication model to local lenders. So make sure that they've done these type of deals before.
And last but not least, you should always make sure to check with your trusted mortgage broker to verify what terms are available to you and your team, as well as the project that you're evaluating.
Absolutely. So while we've covered a number of different loan products and lenders, it may make sense for you as an investor to reach out to and develop a relationship with a mortgage broker. So rather than establishing all these different relationships with different lending partners, you can have one individual, kind of an in-house consultant for the financing aspect of a deal. And those mortgage brokers are compensated in terms of a fee but many times their connections and the products that they're able to provide to you can more than justify paying that fee. So that's one thing that we think that all beginning investors should do, as it's very difficult to be aware of exactly what products are out there at any given time. So don't be hesitant to reach out to a broker just because you're paying a fee.
Thank you, Mark. So on behalf of Maple Capital Partners, thank you for joining us, and we hope you've taken some value from this video.